The U.S. stock market is currently closed. The following analysis is based on the official closing data from Tuesday, October 21, 2025. Nuburu, ticker symbol BRU, closed yesterday's trading session on the NYSE American at 8 cents and 96 cents. That was a devastating drop of nearly 15%, down 14.85% on the day, to be precise. The stock was under heavy distribution, trading over 109 million shares as it cratered, gapping down at the open and setting a session low of 0.276 before finding a desperate, weak bounce into the bell. This isn't just volatility. For a stock already trading under $1, a 15% single-day collapse is a signal of extreme distress. And the immediate assumption might be that this is just another microcap tech name getting washed out in a risk-off market. But the reality of what's happening at Nuburu is far more specific and far more precarious. The expectation many traders have is that BRU is a speculative bet on blue laser technology. The reality is that this is a company fighting a multi-front battle for its corporate survival, dealing with non-compliance warnings from the stock exchange itself and a balance sheet that is flashing code red warnings. Let's establish the common ground, the story that gets traders to click the buy button on their Robinhood app or SoFi Invest platform. The narrative for Nuburu has always been its proprietary technology. The company specializes in high-power, high-brightness blue laser systems. This isn't a vague concept. It has very specific, high-value applications. Blue light is absorbed much more effectively by certain metals, like copper and aluminum, than the infrared lasers that dominate the industry. This makes Nuburu's technology, in theory, ideal for welding the copper foils and tabs inside electric vehicle battery packs, for 3D printing complex metal parts, and for micro-welding in consumer electronics. When you hear that, you think of Tesla stock and Apple stock supply chains. You think of advanced manufacturing. It sounds like a company that should be trading at a premium, a specialist in a high-demand field. That is the expectation. But that expectation is colliding with a financial and operational reality that could not be more different. The real challenge here, the reason the stock is trading for pennies, is that the company is on the brink. Let's look at the numbers from its last public filing, the Q2 report that ended June 30th. The company reported having $111,090 in cash. And let me repeat that, just over $100,000. To put that in perspective, they reported a net loss of over $12.2 million in that same quarter. Their free cash flow was negative $2.89 million. This isn't just a high burn rate, this is an inferno. The balance sheet is inverted. Total assets were reported at $2.48 million, which was down 70% from the previous year. Meanwhile, total liabilities ballooned 144% to $47.23 million. This leaves them with a staggering negative shareholder equity of $44.75 million. This is why the company's own filings contain the dreaded going concern warning, an official disclosure from management and their auditors that there is substantial doubt about the company's ability to even continue operations without securing immediate, significant additional funding. So, when you see a 15% drop on 109 million shares, it's not just market noise. It's the market processing this terrifying financial picture. It's the market realizing that any funding they do get will likely be so toxic and so dilutive that it will effectively wipe out the value for current common stockholders. This isn't a stock you place in your Fidelity IRAs or a Schwab Intelligent Portfolios automated account. This is the definition of a high-risk gamble. The recent price action reflects this. The stock has been trapped in a violent range, with its 52-week low sitting at 0.12 and its high just under $1. Yesterday's move breaks it out of its recent consolidation and puts those all-time lows squarely back in focus. The massive volume, which is distressingly close to its 30-day average, suggests this isn't a one-off panic event. This is institutionalized selling and retail capitulation. There is simply no institutional appetite to hold this. Insider ownership is almost non-existent at under 0.25%. This is a stock that has been abandoned by the so-called smart money and is now left to day traders, a hot potato being passed around on platforms like interactive brokers that cater to high-frequency speculation. This financial crisis is now compounded by a regulatory one. Just over a week ago, on October 13th, Nuburu announced it had received a formal warning letter from the NYSE American exchange. This wasn't about its stock price, it was for violating Section 401A of the company guide. In simple terms, the company released material news, the announcement of a new dual CEO structure on October 1st, during trading hours without giving the exchange the required advance notification. This is a serious procedural failure. It suggests a breakdown in internal controls and corporate governance. For an exchange, this is a major red flag. It adds another layer of risk, the risk of delisting. The company is already in danger of being delisted for its low share price. Adding compliance violations only shortens the runway. This isn't a company that can afford to make unforced errors, and yet here we are. So what was this material news that got them in trouble? This is where the story takes another turn. On October 1st, Nuburu announced a complete strategic pivot. Recognizing that its industrial blue laser story was failing to gain traction against its dire financial backdrop, the company is attempting a Hail Mary pass. It implemented a dual CEO structure, appointing Alessandro Zamboni to handle corporate strategy and finance, and Dario Barasini to spearhead operations. Barasini's key role, he is also the CEO of the new Nuburu Defense LLC. The company's new strategic vision, as stated in its press release, is to expand into defense tech, security, and critical infrastructure resilience. This is a classic pivot. When your primary market isn't working, you rebrand and chase the sector with the biggest government contracts. The company is now signaling to the market that it is no longer just an industrial supplier, it's a defense technology company. The expectation they are trying to build is one of large, non-dilutive government contracts that could save the business. This is the new tension for anyone looking at this stock. The expectation is that this defense pivot is the lifeline. The new management structure is designed to drive its transformation plan and accelerate revenue starting in the fourth quarter. The reality, however, is that they are trying to execute this pivot with $111,000 in the bank and a warning letter from their stock exchange. Entering the defense sector is not fast, easy, or cheap. It requires immense capital, deep connections, and a long, arduous certification and bidding process. Nuburu has none of those advantages right now. This move seems less like a calculated strategic shift and more like a desperate attempt to create a new narrative to attract a new class of investors before the lights go out for good. The market's reaction yesterday, a 15% bloodbath, tells you exactly what it thinks of this plan's probability of success. Let's step back and look at the business itself, the technology that started this all. Nuburu was founded in 2015. Its core innovation, the blue laser, is genuinely interesting from an engineering perspective. For applications like welding copper in EV batteries, traditional infrared lasers struggle because copper is highly reflective at those wavelengths. This means you have to blast it with enormous power, which is inefficient and can cause spatter, tiny explosions of molten metal that create defects and quality control nightmares. Nuburu's blue laser, at a 450 nanometer wavelength, is absorbed almost perfectly by copper. This allows for faster, cleaner, spatter-free welding with less power. It's a textbook perfect solution. They developed the AO150 and BL25 models, targeting battery manufacturing, consumer electronics, and 3D additive printing. But having a good product and having a good business are two different things. The company has failed to convert this technological edge into a sustainable commercial operation. It has been unable to scale, unable to generate meaningful revenue, and has instead just burned through cash since it went public. Looking forward, the pathways for this company are narrowing rapidly. There are really only two scenarios. The bull case, the 1 in a million shot, is that this defense pivot is not just talk. It's possible the new co-CEO, Dario Barasini, has existing deep ties in the defense and security world and can pull a rabbit out of a hat, securing a major